account, sorry, not, right? The third and the last account is financial account of current, of balance of payments, right? So let's first recall what transactions are recorded in the country's financial account, and then we'll talk about possible reasons for deficit. Okay, now students, think about this. We said that there are basically these three sections of financial account: direct investment, portfolio investment, and other investments. What's direct investment? Direct investment is when a foreign business is directly investing in your country, right? Like Amazon opening an office in Pakistan, or let's say a BMW showroom opening up in Pakistan and things like that, right? But on the other hand, obviously your country businesses can also invest in foreign countries. So that will be outflow because your country, your country businesses are investing in foreign countries and so on, right? So direct investment records when a business opens an office or starts a production plant in your country, or your country business starts in a foreign country, right? That's direct investment. Then this is different from what portfolio investment is. What's portfolio? Portfolio investment, I mentioned, is in financial instruments, right? So if Pakistani national invests in US stock exchange or Tokyo Stock Exchange or so on, right? So that means money is flowing out of Pakistan. Vice versa, if foreigners invest in our, invest in our financial instruments in our stock exchanges, then that will be inflow of cash. Other investments record all transactions that are not neatly classified in direct and portfolio investment. They go into other investments. Okay, now coming back to this, why do you expect a country's financial account to be in deficit, right? Which simply means that every year more of your businesses are investing abroad rather than foreign businesses investing in your country. What could be a reason for that? Yeah. What could be a reason for that, right? Right. Anyone? Okay, now think about this. There are a couple of reasons. Think about this. So if you think of direct investment, when will a foreign business be interested in investing in your country? Why does Amazon has an office in China, India, but not in Pakistan, right? Now, there could be two possible explanations for that. Firstly, the Pakistani market is not big enough to justify such a huge investment. I repeat myself. What do I mean by market, right? The market means the population, the purchasing power of citizens, right? Now, just imagine the worth of goods that Amazon can sell in China and India. I mean, that's not that's way too much compared to what they can expect to sell in Pakistan, right? Population is huge, no doubt about that, but perhaps purchasing power is not that good, right? Then comes in cheaper labor and cost. Excellent, Khadija, right? So if costs are relatively much cheaper in India and China, right? So costs are low, revenue is higher, so that makes a good investment case, right? That makes a strong investment case for any business, right? Because people are not interested in Amazon, still people prefer not to buy online. Yeah, that could be another reason. Very nice, right? That there's not much buying online culture in Pakistan, right? So it obviously will mean that less products will be sold, and therefore it's not worth the investment that Amazon would have to made, right? Are you getting me? Okay, now financial account deficits. Think about this, students. Countries, population, and their purchasing power not justifying the investment right? This is making sense, right? So either the country's population. So think of some much smaller countries. By the way, Pakistan is 5th most populous country in the world, right? I mean, so US is one. No, sorry. China is one. Then it's US. I think India is second. I don't know. Then it's US. Then it's Indonesia. And after Indonesia, Pakistan is the 5th most populous country in the world. Right? So, I mean, we are still a huge market, but purchasing power, I think, is relatively low because income levels are low. Per capita income. Do you remember that? We talked about that when we talked about GDP, right? So when you divide GDP with the population of a country, so $300 billion of GDP, let's say, was of Pakistan last year, and then you divided this with total population of Pakistan, which is 220 million, right? So how much each person earns on average per year, that was approximately, I will say, around $1,400 per year. So a typical Pakistani earns $1,400 per year, whereas this would be much higher in case of China, much higher, I think, not sure. But even for India's, it was approximately $2,100 or $2,200 per year, right? So $1,400 per year for a Pakistani, typical Pakistani per capita income, and for an Indian, it was 22 or 2,100, right? Are you getting me? So that's how you do that. Okay. The country's population and their purchasing power is low, not justifying the investment that a foreign business has to make. Then another important point, how much the countries, now this is important, overall political and economic situation, right? So think about this. How much stable is a country in terms of its political and economic situation? That's also something that will determine whether, a foreign business will locate in your country or not, right? Are you getting me, right? So if it's politically stable, you understand what politics is, right? If there are less, issues and strikes and protest, right, then foreign businesses will be more comfortable investing, right? Because they're going to a completely new country. The culture is different, the language is different, the way businesses operate there, the way people behave there are very different, right? So that's what they have to consider. An economic situation is simply speaking how much growth a country is experiencing from year to year, how much is its GDP per capita, how much growth it can expect, right? How much fast growing market it is, and so on, right? Then what Khadija said, right? The costs of production are higher. Higher, which obviously doesn't justify, to locate in that country, right? So if India and China are relatively much cheaper or relatively cheaper than Pakistan, then obviously it's a stronger case of locating there for an American company compared to Pakistan. Easy? Is everyone getting me? If we talk about portfolio investment, type of exchange rate also matters. If a countries have fixed exchange rate, then no one will invest in forex market. Exactly, that's correct, right? Similarly, yeah, that's a good point, right? uh, Portfolio investment. So these points that we have identified here were more of direct investment, right? Political and economic stability. If countries' cost of production are relatively higher, there's no point in investing in that country. And if the country's population is not that huge or purchasing power is not that much, then obviously it means that lesser sale for the business, lesser sales mean lesser profits. Then why would you want to go and locate in that country? Okay, now coming to the portfolio investments, as Zohan rightly pointed out, fixed exchange rate uh, reduces investors' profit margins, portfolio investment, and therefore deterrence for investment in financial instruments. Are you getting me, students? Think about this. So we know what fixed exchange rates are. Fixed exchange rates are staying fixed because government is maintaining them at a certain value, right? Now, how do people who are investing in portfolio investment, who are investing in your stocks, who are investing in your financial instruments make profit? I mean, that's not completely dependent on exchange rate. That's not completely dependent on exchange rate changes, but it does have a major effect. Because think about it, if I want to invest in US stock exchange, first of all, I will convert my rupees into dollars and then only be able to invest in US stock exchange. So if I anticipate, now here's the main thing, if I anticipate that US dollar will in future be stronger or will become more stronger against Pakistani rupee, then that is what will incentivize me to invest in US stock exchange. Yes or no? Are you getting me, right? On the other hand, if I expect that Chinese currency will become weaker against rupees, right? So I might be reluctant to invest in China because when I will convert eventually Chinese currency into Pakistani currency, I mean, I might get lesser rupees. And that's what I'm concerned with. Students, are you following what I'm saying? Right. So for currencies that are expected to go stronger and which are free floating, obviously, the first thing has to be free floating, right? It's not fixed. Then those countries are more likely to attract portfolio investment. And linked to this is Zohan and everyone else. Also linked to this is just like there are regulations and restrictions for direct investment. I repeat, just like there are regulations and restrictions for direct investment, similarly, there could be regulations and restrictions for portfolio investment, right? So some countries are not that open and they don't really welcome foreign investors investing in their stock exchange and things like that. Other countries are more open. So those countries where regulations are relatively easier and investor friendly, then they will attract more investment and vice versa. Um, you invested in which Pakistan stock exchange? Just a second. I mean, uh, okay, okay. So Zohan, that's a discussion for some other day. How can you lose all of it? There will be some value of that investment. I mean, how can you lose all of it? Right. Government regulations are not business and investor friendly. Are you getting me? So regulations basically make up the bunch of regulations. Very simply means I mean all the processes and all the security checks or whatever regulations policies you have to clear before you can do something, before you can invest somewhere, right? So if they are very confusing and not very friendly, they discourage, right? They impose restrictions on foreign investors or they impose other things, then that is what will make it less business and investor friendly country, right? So a simple example that's coming to my mind right now, that in UAE, United Arab Emirates, right? So in UAE, if you want to start a business, you can't start alone. It's not that I take money, if I'm a really rich guy and I just go there and open a restaurant, or I open a car repairing, car workshop business or something like that. No, I cannot. I have to engage a local person, and obviously that person will have some ownership in the business, right? So I mean, I will first go there, find a local person, see if that person is smart enough to be included as a business partner and as a manager, whatever, right? And only then I can start. But this is obviously not the restriction in a lot of other countries, right? So these are the things that discourage foreign investment. Profiting event in loss, and then I got like crazy and then it got messed up. Okay, so we will definitely discuss it some other day. But Pakistani stock market, I mean, I can tell out of my own experience and good 1.5 or 2 years of investment. I mean, it's too much of speculation, and I mean, it's a mess. I can imagine. Other stock markets are not that bad, not that bad. But yeah, this is what portfolio investment is. I mean, there could be huge ups, there could be huge lows, and so on. Yeah, that's why some people have concerns. They don't really invest in these things. They try to invest more in things like real assets, like property or real estate, or let's say gold, and so on. Right? Okay, but definitely, if we get time, we'll discuss more about this, right? Students, are you getting me? So what are possible explanations for current account deficits? The country population and the purchasing power is low. The country's overall political and economic situation is unstable, right? Then another thing that we talked about, the country's cost of production are higher, which means it's less profitable for foreign businesses to invest. Fixed exchange rate reduces investors' profit margins on portfolio investment, and therefore could be huge deterrents for investment in that country's financial instruments. Government regulations and businesses are not investor friendly. Easy. We go on this. Okay. Now, this being said, students, let's quickly talk about solutions of financial deficit. Okay. Now, think about this. So the solutions are pretty simple and straightforward, right? So perhaps these two things is not, I mean, especially this one is not what a country can really help you with. I mean, if GDP per capita is low, it will only be after a couple of years with, constant growth that a country will become, it will become more prosperous with more purchasing power and things like that. So you can't get a quick fix. That's what I mean. They can't be a quick fix when it comes to the size of your population and when it comes to your GDP per capita. But there are some other things that you can quickly fix. The most important of all is the government regulation. So if you really encourage, if you really want to boost foreign investment, then what you need to do is to sit down, and relevant departments in your government need to sit down and brainstorm and think about what's discouraging foreign investors from investing in your country and what can you do to facilitate them, right? Right? Are you making sense of this? Right? So these are some of the things that you have to think about: making more business and investor friendly policies, then having economic and political stability. Nothing but this. When I say economic and political stability, what it simply means that even if a country is not doing too good, even if a country is not doing like economically, the growth rate might not be skyrocketing or things like that. But if it's kind of stable, there's constant growth from a year to year basis, political situation is very, friendly. Like think of countries like Singapore. Singapore, I mean, it's not a huge economy. I mean, it does good, but I mean, not that big of a economy and things like that. But why are there so many businesses and offices and all this foreign investment comes in? Because I mean, it's a multicultural country. I mean, policies are very stable. They're investor friendly. And it's politically very stable and things like that. So that's why it attracts a lot of investment. Are you getting me? So these are the things that you should be thinking about: having more economic and political stability, making more business and investor friendly policies. Okay, what else? Anything else coming to your mind? Right? And then obviously having more GDP per capita, attract larger businesses, larger foreign businesses. By increasing their profit margins. Easy, we good on this, right? So these are some of the things that you can do to increase your to reduce your financial account deficit. We good on this, right? So students, is everyone clear? Right? Okay, now let's stop here for today. Right? So let's stop here for today, and tomorrow we'll continue from here, right? So till then, take care, have a good night, and get some good rest, right? Okay, take care. Allah Hafiz.